Good afternoon and welcome to our webinar, Tax Tips for Micro Businesses in COVID-19. My name is Debbie Naselrode and I'm the Women's Business Center Director with New Growth. The Women's Business Center serves 13 counties in Missouri and 2 in Kansas. The New Growth Women's Business Center is supported by the Small Business Administration and is part of the Start Here Business Acceleration Network. Together, we're working to get rural entrepreneurs growing and growing. With business counseling, education and training, financing, credit building, mentorship, leadership building, peer-to-peer networking, and certifications. Learn more and track upcoming trainings at our website, newgrowthmo.org, and follow us on social media at newgrowthmo. Today, we're pleased to offer this webinar, Tax Tips for Micro Businesses in COVID-19 Times. Our presenter is Timothy Roscoe Carter. Timothy Roscoe Carter is a qualified tax expert with the Low Income Taxpayer Clinic and Justice Diversity Center of the Bar Association of San Francisco. Tim earned a law degree and Master's of Science in Taxation from Golden Gate University and has spent 2 decades preparing taxes and practicing administrative law. For those who might be wondering, why do we have a San Francisco attorney working with us here in rural Missouri? It just happens that Tim is my cousin. Our parents are siblings, his mom and my dad, so we share roughly 15 or 12.5% of our DNA.
Yeah.
He's known me all of my life, and when I became the Women's Business Center Director, he reached out to me about resource sharing and the wonderful presentation he has for you today. A little housekeeping before we get started. Please put your questions in the Q&A area. We will record this and send the link along with a copy of the slides to your post-webinar, and we will also have it our newgrowthmo.org website. Tim, take it away.
Thank you, Debbie. So yeah, we'll be discussing tax tips and particularly for small growing businesses during COVID-19. And just to let you know, a lot of different people can be can be their own business. I have a list here including day laborers, people who own Airbnbs, some party entertainers, consultants, anybody who files a Schedule C is on their taxes is their own business. So, and one of the first things you're going to be looking at in terms of putting your business on your taxes is determining whether the IRS is going to see what you're doing as a business or a hobby. If the IRS decides that your business is actually a hobby, it could have significant tax consequences. If you're a business and you can deduct losses. Well, actually, I have this written wrong here, because if you're a hobby and not a business, you can only deduct losses up to the income that you have earned. But a business can deduct losses beyond their income. And the IRS presumes that you are a business if the activity is profitable for 3 of the last 5 years. You'll hear that rule a lot, but note that this is a presumption and it can be overturned with evidence. The real test is not just the three out of 5. It's a facts and circumstances test. And they have 9 example factors. Those are not the only factors, but there's 9 example factors listed in the regulations. You can go to the regulations yourself. It's CFR section 1.183-2. But the important concepts to think about is the business-like manner of your activities, such as your record keeping and keeping separate accounts, and also a demonstration of an intent to earn a profit. Examples include if you're doing marketing, if you have a business plan, and how much expertise you have in this. If you think about it, like if you're not doing marketing, then that makes it look like this is a hobby. You're just doing it to have fun. If you're doing significant marketing, you're doing that because you want to earn money. How do you report your income and expenses? Well, at tax time, you may receive a 1099 miscellaneous and or 1099-K, subject to certain minimum limits. As you'll see in a moment, something else I need to update, which is I have later on. It could be a 1099. It used to be a 1099 miscellaneous. It's now a 1099 NEC, non-employee compensation. Some places, though, you might also receive, for some things, you might still receive a 1099 miscellaneous. But even if you do not receive a 1099, you still must report all of the income that you've received, and you report the income on a Schedule C or Schedule CEZ, which is the profit and loss for businesses. Here's an example. I'll move this a little so you can see this is the Schedule C, profit and loss from business. And it's the 2-page schedule that is attached to your 1040 for the year. Filing requirements. You must file taxes if you had net earnings from self-employment of at least $400. And this filing requirement is regardless of whether you had enough total income to meet the other filing requirement threshold. So if you start your own business, if you make even if you only make $400, it doesn't matter that you normally don't pay taxes, you normally don't make enough. That $400 is enough to trigger a filing requirement for the year. Something to keep in mind about filing your taxes and reporting your self-employment income is that you should file your taxes if you are eligible for the earned income credit or the additional child tax credit. The EITC and the ACTC are refundable credits. This means you can receive them even if they exceed your tax for the year. But for both of these, you must have earned income to be eligible for either credit. The child tax credit, they've actually changed the earnings requirement. I think I have it later for 2020, but for 2021. But the general rule for both of them is that you have to have earned money, which can include your business earnings, in order to be eligible for either the earned income tax credit or the additional child tax credit. When you're earning money as a business, you have to pay self-employment taxes under a pay-as-you-go system. Because you're earning the money, and you're bringing in the income, the taxes are not automatically taken out of your income the way they are when you're an employee. And you have to make payments through the year to avoid penalties through the quarterly estimated taxes. And for some people, depending on how much they make in a business, they may need to pay it more than quarterly, but it's generally quarterly here. There's a penalty if you do not pay your estimated payments, and you can keep track of this however it works for you. Calculating your estimated payments, there's a simple method here which gives you the simple method is an estimate, because what it really matters is what it's going to be at the end of the year. And you don't actually know that, obviously. You can do a lot to try to work out what you think it's going to be and compare it to your taxes. But one simple method is just to pay 20% of your net business earnings. And for that, you need to know how much you were paid and how much you paid out for business expenses. When you make estimated payments, so even though these are quarterly payments, the quarters are not all 3 months for some reason. The first quarter does cover the first 3 months of the year. The payment is due on April 15th. And then you have from April to the end of May is the second quarter, which is then only 2 months, and that's due on June 15th. And then the third quarter is the 1st of June through the 31st of August. And that's due on September 15th. And then the last quarter is actually 4 months. And that's from September 1st through December 31st, and it's due on January 15th of the next year. So here's an example of making estimated payments. So for April, May, and June, the second quarter, you worked for 12 weeks with no vacation. You got paid $350 each week, and you paid out $600 in business expenses. So your total of what you got paid was $4,800. You subtract the business expenses of $600, leaving you $3,600 in net earnings. Multiply that times the 20%, and that would be $720, which you would make as an estimated payment for that quarter. To make the estimated payments, you can do it online at irs.gov/payments. You can mail a check or money order using the IRS Form 1040-ES, which you can print off of irs.gov, and it has coupons and mailing and the mailing address. And it's probably good to consult a tax preparer and definitely keep a record of your payments. Here's an example of one of the vouchers. So this would be for your for 2020 estimated taxes. This would be payment voucher 4. So this would be this would have been for somebody who needed to do this. It would have been due January 15th of this year, and then this would be like if you were due for the first quarter of this year, and then this one would be due June 15th. Who has to make estimated tax payments. If you will owe $1,000 or more in taxes on your return, you must make estimated tax payments. Otherwise, you will be penalized for underpayment. For example, a taxpayer who earned $15,000 in net self-employment income, and then using the 1040 ES worksheets, they'll owe an estimated $2,373 in taxes, and is required to pay $534 each quarter to avoid a penalty. And then if you compare that to somebody who earned $15,000 in wages, they would owe just $1,788 in taxes, a difference of $585. Which brings us to payroll taxes. So when you're hiring, if you're earning money or if you're hiring someone else, you need to consider whether the relationship is one of being an employee or an independent contractor. So an employee works for another person or organization. They end up receiving a W-2 for the work they performed. They have taxes withheld from their paycheck, and the employer pays 50% of the payroll taxes. For an independent contractor, that's also someone who works for another person or organization, but they receive a 1099 NEC or 1099K for the work they performed. They do not have taxes withheld from their paycheck, and the worker pays all the payroll taxes. So if you're hiring somebody, it's important to know before you hire them, and even when you're deciding sort of how to hire them, whether this is going to be an employee and whether you're going to have payroll tax responsibilities. If you have an employee, you must withhold income and FICA taxes from their wages, and you must match the FICA taxes. So whatever you withhold in for the FICA taxes, you have to pay that as well. You must pay at least quarterly, sometimes more often. You have to get an employer identification number. There are stiff penalties for errors. And you can find more information about this in publication 15, also known as Circular E, the Employer's Tax Guide. So independent contractors are self-employed. You're considered self-employed for tax purposes. If you work as an independent contractor, you receive a Form 1099 for the money, reporting the money that was paid to you instead of a W-2. You carry on your trade or business as a sole proprietor. You can also be an independent contractor if you're a member of a partnership that carries on a trade or business. And otherwise, you're in business for yourself. That includes even if you're just doing it part-time. So which form for reporting? Here's an example of the form W-2 up I have here, and then I showed here's the for 2019, there's a 1099 miscellaneous, which is what a lot of people are used to receiving as independent contractors. For 2020, and I have the 2021 here, but it's now the 1099 NEC, the non-employee compensation for an independent contractor. What kind of tax deductions and how do you take your tax deductions as a small business owner? Well, first you need to consider your record keeping, because before you can deduct any business expenses on your tax returns, you must keep meticulous records that conform to IRS standards. If you are audited and do not have the appropriate records, the deductions will be disallowed and you will owe additional taxes, penalties, and interest. I should note back here, I should note that also includes, you need to also think about keeping records of your income as well, that you have to keep the meticulous records of your income, because the IRS will sometimes challenge your income if you are trying to claim a refundable credit, like I mentioned, the earned income tax credit or the additional child tax credit. If you're basing some of that on the earned income from your business, you need the records of having received that business, because the IRS does challenge that for people. Some common business deductions include the home office expense, car and truck expenses, insurance, rental expenses, depreciation for the use for equipment used in a business, health insurance premiums, and internet and phone. There's also what the Section 1099A deduction, which is a qualified business income deduction. And self-employed taxpayers can deduct up to 20% for sole proprietorship, S corporation, or partnership. It's generally available to eligible taxpayers whose 2020 incomes fall below $326,600 for joint returns, or $163,300 for other taxpayers. It applies to income earned from a qualified trade or business, though there are some limitations. Many small businesses, and most small businesses, will be able to benefit. The deduction amount for each trade or business is determined separately, then added together. So if you have more than one trade or business, you figure it out different for each one. Home office expenses, you can claim the deduction using the simplified or regular methods. It's shown in publication 587. The basic requirements for your home to qualify as a deduction, you need to have the regular and exclusive use. Either a whole room or a segregated part of the room must be exclusively used for your business, and it must be the principal place of your business. You can deduct car and truck expenses using either the standard mileage rate or your actual expenses. Car and truck expenses include the ordinary and necessary costs of traveling between workplaces or clients. It does not include commuting expenses, so travel between your home and your place of work is not deductible. And so as an example here, a taxpayer who works for Lyft or Uber cannot deduct the mileage or expenses from their house to their first ride of the day. However, they can claim expenses for the trips between rides because they've already started work, so they're already at work when that first ride ends. And so going to get the second ride is that mileage is now part of their business mileage. So the two different ways you can do this: standard mileage versus actual expenses. The standard mileage, you just use the standard mileage rate, deducting a flat 56 cents per business mile. That's the amount for 2021. The amount changes, but for 2021, it's 56 cents. And you must elect the standard mileage rate in your first year in order to claim it in the future. And this uses a lot less record keeping. You only need to keep a mileage log and periodic odometer readings. The other way is to use the actual expenses. So you would, like the gas, repairs, insurance, license, lease, depreciation, and you must keep receipts for all expenses in order to claim the actual expenses. And note here that if you use your car for personal reasons, you must prorate the expenses based on the number of business versus personal miles driven in the year. So if you're using your car for both business and personal, you're going to have to keep a mileage log anyway. So you're going to have to do that just like you would for the standard mileage rate plus all of the other expenses. Now, it may turn out to be to your financial advantage, but you have to weigh that against the record keeping. Regardless of whether you use actual expenses or the standard mileage rate, parking and tolls are separate. So you can take the standard mileage rate and add on parking and tolls. If you use an item for both personal and business use, such as your cell phone, you can only claim the expenses that are based on the amount that you use for the business. And you apply a percentage to the total cost based on the amount you used for business purposes only. Now to get to some small business tax issues that are particularly related to COVID-19. So you may have heard employees who receive sick leave wages, they've been able to get more sick leave. So employees who receive sick leave wages under the Emergency Paid Sick Leave Act or family leave wages under the Emergency Family and Medical Leave Expansion Act, which were both passed just over a year ago, I think here. And they have to include those wages on their income. That question came up because these acts provided incentives to businesses to pay extra wages, but the incentives went to the businesses to pay the sick leave or the family leave, and then the employee just treats them as regular wages and has the same tax consequences. However, for self-employed individuals, people running small businesses, if they would have been entitled to receive sick leave wages under the Emergency Paid Sick Leave Act or family leave wages under the Emergency Family and Medical Leave Expansion Act, if they had been employees, they are entitled to a special tax credit, and it's for 2020 only. And it can be claimed by attaching Form 7202 to your Form 1040 for 2020. So the sick leave credit qualifications. You were a self-employed individual unable to perform services for one or more days from April 1st, 2020 through December 31st, 2020 for one or more of the following reasons. You were subject to a federal, state, or local quarantine or isolation order related to COVID-19, or you were advised by a health care provider to self-quarantine due to concerns related to COVID-19, or you were experiencing symptoms of COVID-19 and seeking a medical diagnosis. So you didn't go to work. It may have turned out you did not have COVID-19, but you were a responsible person and did not want to potentially expose other people, and you didn't go to work and you didn't earn money for a certain amount of days while you were waiting for to get the testing and get the results. You still get you can still claim the sick leave credit for that, even though it turned out you did not have COVID-19 and never got an order from a government official or a doctor. Next is the family leave credit qualifications. This is available if you were a self-employed individual unable to perform services for one or more days from April 1st, 2020 through December 31st, 2020 for one or more of the following reasons. You were caring for an individual who is subject to a federal, state, or local quarantine or isolation order related to COVID-19, or you were caring for an individual who was advised by a healthcare provider to self-quarantine due to concerns related to COVID-19, or you were caring for your child because the school or place of care for that child was closed, or the child care provider for that child was unavailable due to COVID-19 precautions. Now, what this can mean is that, let's say you have a small business, you normally work at home. You could and did continue some of your work during COVID-19, but for some days. But normally, working at home, you work at home because and you can work at home because your child goes to school. But even though you work at home and could theoretically do that during COVID-19, your child, the school was closed, so you had to watch the child because of COVID-19, and you couldn't work for a lot of days during COVID because your child was home. You are eligible for the family leave credit for 2020. So the PPP loans, this is a lot of people think of this for the medium-sized business, but a lot of small businesses and even sole proprietors were eligible. I'm not sure if the windows have closed for the current ones or not, but they have been, even some sole proprietors have been eligible for PPP loans. Normally the way the PPP loans work is that if you use the loans to pay employee salaries, those loans are forgiven. For sole proprietors who don't have employees, they're allowed to use their net Schedule C income as a payroll expense, and that is what is forgiven on the PPP loans. Expenses that are paid with forgiven PPP loans are tax deductible, and forgiven PPP loans are excluded from gross income, and the tax basis of forgiven loans is not reduced due to loan forgiveness. And it's notable here that those last 3 points are an exception for PPP loans, which is different from most loan forgiveness. Usually, if you have loan forgiveness, you cannot take deductions, and for something you spent if the loan was forgiven. Usually, if you get a forgiven loan, that forgiven loan is income, and it also affects your tax basis. But none of that is true for forgiven PPP loans. Okay, back to the important issue particularly for small businesses of record keeping. So why should you keep records? An important reason here is audits. If you were ever audited by the IRS, you will need records to substantiate the expenses and the income that you claimed. The IRS considers documentary evidence adequate if it includes the following information: the amount, date, place, and nature of the expense. And that is the nature should refer to the business purpose of the expense. So types of records to keep include receipts, invoices, bank and credit card statements. The bank and credit card statements are not enough on their own. They must be accompanied with receipts and invoices. Copies of canceled checks, the mileage log that I mentioned earlier, a business calendar, and your profit or loss sheet, your balance sheet, and your general ledger. All of these are good both for very specific documenting the specific expenses, and also, like I said, these show the business-like nature of the way you're conducting yourself to show that you are a business and not just a hobby. Here's examples of an invoice or a receipt. Example of a mileage log showing the date where you went from or to, the business purpose of it, the odometer readings, and how much the expense was. Your profit and loss sheet, you should consider using software such as QuickBooks to organize your business receipts and expenses. This will help you keep track of expenses throughout the year. If you don't do that, you can also use your own format for a profit and loss sheet. One suggestion of how to do that would be to use Schedule C itself as a guide for how you should categorize your expenses. So, for example, I showed the Schedule C earlier. Here's a blow up of part 2 of the Schedule C, which is the expenses and where you put the expenses. So if you're making your own spreadsheet, one thing you can do is just go through and each of these line items, make that a column on your spreadsheet. And then as you go, and then just daily as you pay your expenses and you enter it on your spreadsheet, putting in the right column, at the end of the year, boom, you just need to get the, just take the totals at the end of each column and enter them into this section of the Schedule C. It's important and useful to keep separate business and personal accounts. It demonstrates the business-like manner of your activity to the IRS. And you also want to make sure that you have a special designation for extracting profits, that is paying yourself. It makes it easier to show that an expense was for the business and not for personal use. So, for example, sometimes you might have to take out cash for the business, but sometimes you're going to take something to yourself for yourself. Sometimes when people are paying themselves, they'll write out a check to cash. Sometimes they may designate it under their name. However you do it is fine. The most important thing is to be consistent and do it the same way every time. And also be sure to use separate designations for capital contributions and business receipts. It makes it easier to show a business loss, and it also makes it easier to show earned income for purposes of the EITC and the ACTC. And then startup expenses. So you keep track of all of your expenses from the moment you start even considering having a business. Note that you cannot deduct them before the year the business begins, though. But in the year the business begins, you may deduct up to $5,000 of startup expenses, minus the amount such expenses exceed $50,000. The remainder of your startup expenses can be deducted ratably over a 180-month period. That's 15 years, beginning the month the business begins. And the year your business ends, you may deduct the remainder of your startup expenses. So an example here, say in 2015, you start investigating or deciding putting together a business and you had $8,000 in expenses. In 2016, then you spent $12,000 in expenses from January 1st to October 19th, and you opened your doors on October 20th, 2016. You had a good 8 or 9 year run here, and then the business closed in 2025. So with everything you spent prior to October 20th of 2016, the total startup expenses was $20,000. So the startup expense deduction then that you have in 2015 is 0 before the business began. In 2016, your startup expenses, you can deduct $5,250. That's $5,000. That's the first $5,000 plus 3 months of the prorated business expenses. 3 months because it includes the month you started. So even though it's late in October, you count October, November, and December. And then as for 2017 through 2024, your startup expenses, you'll just be able to deduct an extra $1,000 a year. And then because that's the 15,000 left over divided by 15. And then the amount that you'd have left over in 2025 that you haven't deducted from the original 20,000 is $6,750. And so all that's deducted in the year that it ends, the business ended. Okay. Let's see. All right. Potential tax problems. Audits, the IRS can audit a return that you file for 3 years. And if the IRS finds a substantial error on your return, they can go audit up to 6 years. And that's why, just to be on the safe side, usually people tell you to keep the records for 7 years. And you also need to remember to file a tax return, even if you cannot pay the balance. If you do not file a tax return, the IRS has unlimited time to assess taxes based upon what they received, based upon the information that they received from third parties. So these audits, these time frames that I just gave start from when you filed or when you were supposed to file your taxes if you did file. But if you don't file, then you don't start the clock. Your chances of getting audited are much greater if you file a Schedule C, if you take home office deductions, if you have business losses, or you claim entertainment deductions. In some statistics here, in 2012, 1% of all returns were audited. But even if you had under 25,000 in gross receipts, your audit risk, for filing a Schedule C, was 1.2%. So that was a 20% increase, even if you had receipts under 25,000. If you had receipts between $25,000 and $100,000, your audit risk was 2.4%, which was more than double the normal audit rate. So note, you're running a business, you're more likely to get audited, so keep your records. Another reason to file your tax returns if you're self-employed is that the Social Security Administration will only credit you for self-employment wages for 3 years. So if you wait more than 3 years to file, then you will not receive Social Security credit for your self-employment income, which means that you will receive less money in Social Security disability benefits or your retirement benefits. So what happens if you don't pay your taxes? The IRS can file a lien on your property. probably the state, I don't know this, I put franchise tax board, that's California. Um, I don't know Minnesota rules, but I assume they can too. They can levy or force the collection of tax by confiscating money directly out of your financial accounts or from accounts receivable. Tax garnishment, they can garnish a portion of your wages. So you might be running a business and be an employee as well. They can garnish your wages. And the IRS has 10 years to collect taxes once the taxes are assessed. Again, if you don't file your taxes and you take and either they file for you many years later or you file many years later, that 10-year clock doesn't start to run until the tax is assessed. I point in here the franchise tax board has 20 years. I don't know what it is in Minnesota, but just note that the states have their own time frames that are different and can be longer than the IRS, than the IRS. Am I getting the? You're in Missouri. Oh man. Okay, sorry. I got that wrong for something else that I did later. I thought I was doing good, but anyway. Okay, tax lien issues. So the effects of a tax lien. If there's a tax lien put on your property, if the property is sold while a lien is in effect, the government agency will be paid out of the sales proceeds before the taxpayer is paid. This effectively prevents the refinancing of assets to which the liens have become attached. It becomes part of the permanent record. It may prevent the delinquent taxpayer from being able to borrow money, and it may prevent the delinquent taxpayer from obtaining employment or public housing. What if you can't pay the tax due or you owe back taxes? You should always file your tax return on time, regardless of whether or not you can pay. One of the reasons for this is that the penalty for if you owe taxes, if you do your tax return and you find you owe $3,000, you can't pay that. It's better to pay because the penalty for filing it and not being able to pay it is 0.5% each month. The penalty if you don't file it and you can't pay, the penalty on that on the amount that you owe is 5% per month. So that's 10 times the penalty if you don't file and don't pay, rather than if you file and just don't pay. Options when you owe taxes are that you can try to get an installment agreement where you make monthly payments towards the liability until it is paid in full. This can be set up online by telephone or in person with the IRS or the Franchise Tax Board. You can ask for an offer in compromise where if you qualify, the IRS will agree to accept an offer amount often much lower than what you owe. They also have something called currently not collectible status, where if you can't afford an installment agreement, but you don't qualify for an offer in compromise, the IRS will not levy your accounts, but you will still owe the money until the statute of limitations expires. This is often for people who they think you can't pay now, but we think you might be in a position in the future where you can. And so if you get into one of these situations, you can contact a low-income taxpayer clinic. The low-income taxpayer clinics, it's a national program which is funded by the National Taxpayer Advocate Office. We provide free representation and advice to low-income taxpayers before the Internal Revenue Service in audit, appeals, collection, and before federal courts in matters of tax litigation. And to emphasize for purposes here that does include individuals who own small businesses, particularly, again, the Schedule C is part of your individual taxes, and we deal with that frequently. Even if you have other type of businesses, sometimes we deal with people who have partnerships or Schedule K. We deal with that less often, but not because we exclude it, but just because those people rarely meet our income guidelines. But yes, we do handle businesses as well, as long as you meet our income guidelines. The LITCs, we receive matching funds from the IRS via a grant program, yet we remain completely independent of and are not associated with the federal government. That's why we can sue the federal government. And each clinic independently determines if a prospective client meets the income or poverty guidelines and other criteria before we agree to represent a client. And we help ensure the fairness and integrity of the tax system by educating taxpayers about their rights and responsibilities, providing free representation to taxpayers in tax disputes with the IRS and in tax court, and identifying and advocating for issues that impact low-income taxpayers. Again, sorry, I found you can go on the IRS website and look up the LITC locator tool to find your local.
I have that link that we'll be providing into the chat here shortly for the Missouri low-income tax clinics.
Great, thank you. Sorry about this. And then other resources, there's the Pub 34, the tax guide for small businesses, which you can get from the download from for free from irs.gov, and then the irs.gov/business is a general resources for business, and more specifically business/small business self-employed section has a bunch of other resources specifically for small businesses. And I just want to thank Anna Gooch, one of our volunteers who helped put this together. And now I'm ready for questions. Let's see. An offer in compromise, the taxes you do not pay will be counted as income in the next tax year.
I'm just asking, that's what an accountant told me, that if you make an offer in compromise for a couple of $1,000s, if you owe $20,000, they'll say that other 18,000 is counted as income. Is that incorrect?
I would say that's incorrect. At least, okay, I don't know. Like I said, I'm hearing this sort of third hand, and so I don't know if he was wrong, if he didn't explain it well, if something got lost in translation, if you may have forgotten a little part of it or something. I mean, no, all of those could happen. Now there may be something here where I mentioned earlier when I talked about the PPP loans that usually forgiven loans are considered income. And so to the extent that you that you owe somebody money and they forgive part of that, that's usually considered income, unless there's a specific exception like it is for the PPP. Now, the difference here is that it's the actual tax itself. So that would be a kind of weird sort of recursive thing to say that you owe tax on it's owing tax on the tax, because no, this is the tax itself, and so it doesn't apply there. So if you're specifically with the IRS, now what you've just made me want to do though is go look up whether or not if somebody settles their state tax for less, does that count as income for the IRS? I had never thought of that question before, and I don't know the answer. And so now you're making me want to look that up. And like,
I'm
for
glad I could
example, there
help.
might be something that may, and if it turns out you do, maybe that's what they were talking about. I don't know. Or they may have been talking about like an offering compromise, like compromising some other debts, because any other debt you compromise consumer debt, you come to some agreement on that. Yeah, that's going to be income for the IRS.
Okay, we have a couple more questions. One is, what about multi-level marketing?
I don't know if I had that on there, if I switched that out when I was trying to include other stuff, but multi-level marketing, it is a business. And so I don't want to go into all my thoughts of multi-level marketing. I have mixed thoughts on it in general, but from a tax perspective, you are running your own business, and so you need to keep records of all the business records of all of the money that comes in. That's business records that you have to keep track of. All of the money that you pay out, including if you're buying samples, if you have to pay for the samples, that's part of your business expenses. The licenses, if it's like a franchise type operation, franchise costs are businesses. For the multi-level marketing, I know you pay a certain amount of your profits or the amount that comes in. I don't know how that's worked out, if it's considered like a royalty or if it's on your net or gross, I don't know, but all of that you pay going back upstream, that's part of your expenses that you need to keep track of. Yes, it's you're running a business.
Okay, the next question was regarding credits for sick leave and loss of work due to COVID. What documentation is needed for instances not related to official stay-at-home order?
Okay. The top line answer is I don't know. I would say anything that documents that to the best you can. If you so for the sick leave one where you were afraid you might have COVID, if you have any records of having taken a COVID a COVID test, I would go find that and try to keep that. That would show the date that you took the test, and then if you got back, you probably called in for the results, so you may not have a record of that. But if you do have a record, if it came in an email, get that. Any records around that showing that would somehow show that you didn't come in on that day or you didn't log in. Whatever you normally do to, I mentioned one of the records that you can keep is your business calendar. If you went in and if your business calendar, I would say it has scratches. Who does that on there? I don't think anybody actually does that on paper anymore, but if you do, keep that. If you don't, if you have anything that shows the changes that you made, that helps. For your if it's for the family leave, anything that you got saying from the schools or from your child care provider. If your child care provider couldn't, if you had a child care provider who came into home but they couldn't come into home, if you have any records of that. Again, like I said, the school record showing that here are all the stuff that we're doing for COVID, and sorry about this. I know I got a lot of stuff from the school, so go back and find that. Anything that just documents and evidence. There's nothing standard because this is not standard. This is something new.
Okay, does anyone else have any other questions for Tim? All right, well then I guess we'll go ahead and
if we have extra, is Kelly Ernst on here?
I don't think so.
Oh, okay. Never mind.
Yeah, she's not.
Okay.
Okay, let's see. All right, well, if no one else has any questions, Thank you all for joining us today. And thank you again, Tim, for taking the time to share your tax tips for small micro businesses. Again, the 3 low-income taxpayer clinics are available in Missouri. We have the Legal Aid of Western Missouri, LITC, located in Kansas City, the UMKC Kansas City Tax Clinic in Kansas City, and Washington University School of Law, LITC, in St. Louis. The link to that is in the chat. And in addition, the University of Missouri School of Law in Columbia offers entrepreneurship legal clinic to small and startup businesses. And that clinic assists members of the university and mid-Missouri communities seeking to start businesses by providing supervised legal services involving entity planning and formation, governance issues, employee issues, intellectual property analysis, government regulations, and contract drafting. And that link is also in the chat. So if that's all we have today, thank you all again for joining us. And again, thank you, Tim, and have a wonderful rest of your day.
I apologize. I imagine mixing up Minnesota and Missouri is probably the most California thing I could have done, I imagine.
Well, we're definitely quite different than Minnesota from my experience. So yeah, we're a lot more rural, I guess, but.
Okay. Yeah.
All right. Well, thank you all for joining us and have a great day.